Welcome to Lesson 3 of Week 8. Today we examine two fundamental concepts that every grant professional must understand: allowable costs and allocable costs. These two tests, along with reasonableness, which we covered in the previous lesson, form the foundation for determining whether any expense can be charged to your grant. The terms sound similar and are sometimes confused, but they address distinct questions. Allowability asks whether a type of cost is permitted under applicable regulations and grant terms. Allocability asks whether a specific cost benefits your particular project. A cost must pass both tests to be legitimately charged to a grant. Understanding these concepts thoroughly will help you make confident decisions about grant expenditures, prepare accurate budgets, and defend your spending choices during audits. We will explore each concept in depth, examine specific examples of unallowable costs, and learn how to determine allocability in various scenarios. Remember that regulatory specifics discussed were accurate as of November 2025. Always verify current requirements at ecfr.gov before making compliance decisions. By the end of this lesson, you will be able to evaluate any potential expense against both the allowability and allocability standards. Allowability is the first gate every cost must pass. It answers the fundamental question: is this type of expense permitted under applicable rules? The answer comes from multiple sources that must all be checked. Universal rules in the Uniform Guidance make certain costs always unallowable for federal grants. These categorical prohibitions apply regardless of which agency funds your grant or what your project involves. We will review specific examples shortly. These universally unallowable costs cannot be charged to any federal grant under any circumstances. Funder-specific rules may prohibit additional costs beyond the universal restrictions. Each federal agency has some discretion in implementing grant requirements. A particular agency might prohibit costs that are allowable under general rules if they conflict with agency policy or program purposes. Review your funder's specific guidance for additional restrictions. Award-specific terms in your notice of award may include unique restrictions. Reviewers might recommend limiting certain costs. Program officers might require prior approval for purchases above certain amounts. Your specific award terms may restrict costs that would otherwise be allowable under general rules. Always read your award documents carefully for any cost limitations. The key insight is that allowability is determined by the most restrictive applicable rule. A cost that is allowable under general regulations might still be prohibited by agency policy or award terms. Certain costs are categorically unallowable on federal grants regardless of circumstances. Understanding these universal prohibitions prevents costly mistakes and audit problems. Alcoholic beverages are never allowable on federal grants, as specified in 2 CFR 200.423. This prohibition is absolute. You cannot charge wine for a project reception, beer for a research team celebration, or any other alcoholic beverages regardless of how reasonable the expense might seem in context. Entertainment costs are prohibited under 2 CFR 200.438. This includes costs of amusement, diversion, social activities, and associated costs such as tickets, meals, and transportation. A common confusion: project events with legitimate purposes may be allowable, but the entertainment component is not. A working lunch at a project meeting might be allowable. Dinner and a show for project staff would not be. Lobbying costs are prohibited under 2 CFR 200.450. This includes costs of influencing federal or state legislators, attempts to influence legislation, and campaign contributions. While advocacy and public education related to your project may be allowable in some circumstances, anything crossing into lobbying territory is prohibited. The Uniform Guidance contains an extensive list of selected items of cost in sections 200.420 through 476. Review this list at ecfr.gov for the current text, as these provisions may be amended. Understanding what is explicitly prohibited helps you avoid common pitfalls. Additional categories of costs are universally unallowable, reflecting the principle that grant funds should support direct project purposes rather than general organizational needs or problems. Bad debts, including losses from uncollectible accounts and related collection costs, cannot be charged to federal grants under 2 CFR 200.426. If someone owes your organization money and fails to pay, that loss cannot be passed along to federal funders. Grant funds are not intended to cover your organization's credit losses. Fines and penalties imposed by government agencies are unallowable under 2 CFR 200.441. If your organization receives a fine for regulatory violations, parking tickets, or any other government-imposed penalty, these cannot be charged to grants. The organization must bear responsibility for its compliance failures. Fundraising costs, including organized fundraising activities, financial campaigns, and endowment drives, are prohibited under 2 CFR 200.442. Grant funds should not subsidize your efforts to raise other funds. While some activities related to grant management might appear similar to fundraising, true fundraising costs are always unallowable. Contingency provisions, meaning funds set aside for unforeseen events, are generally unallowable under 2 CFR 200.433. You cannot budget a general reserve for unexpected costs. Instead, your budget should reflect realistic estimates of actual anticipated expenses, with any necessary adjustments handled through formal budget modification processes. Between universally unallowable costs and freely allowable costs lies a middle category, conditionally allowable costs. These require additional steps, approvals, or documentation to be charged legitimately. Some costs are allowable only with prior approval from the federal awarding agency. These typically include significant expenditures or activities that might raise concerns. Foreign travel often requires prior approval. Major equipment purchases may need advance authorization. Changes in scope or key personnel typically require approval. The specific items requiring prior approval vary by agency and award, so review your terms carefully. Some costs are allowable only within limits or under specific circumstances. For example, certain administrative costs might be allowable up to a percentage cap. Participant support costs might be allowable but restricted to specific uses. Understanding these conditional allowances helps you stay within bounds. Documentation-intensive costs may be allowable but require extensive justification. Consultant costs are generally allowable but require documentation of rate reasonableness and selection process. Sole source procurements may be allowable but require detailed justification for why competition was not feasible. The cost itself is not prohibited, but charging it requires more supporting evidence than routine expenses. Allocability is the second essential test for grant expenditures. While allowability asks whether a type of cost is permitted, allocability asks whether a specific cost belongs on your particular grant. Understanding this distinction is crucial. A cost is allocable to a federal award when the goods or services involved are chargeable or assignable to that award in accordance with the relative benefits received. In simpler terms, does this expenditure directly serve this grant's objectives? The core question for allocability is straightforward. Does this cost benefit this specific project? If you purchase supplies that will be used entirely for grant activities, those supplies are fully allocable to the grant. If you purchase supplies that will be used half for the grant and half for other activities, only half the cost is allocable to the grant. Proportional allocation applies when costs benefit multiple projects or activities. Your organization likely conducts many activities beyond any single grant. Costs that benefit multiple activities must be allocated fairly among them. Charging the full cost of shared resources to a single grant when other activities also benefit is improper and potentially fraudulent. 2 CFR 200.405 establishes allocability requirements. The regulation specifies that a cost is allocable if it is incurred specifically for the award, benefits both the award and other work, and can be distributed in proportions that reasonably reflect benefits, or is necessary to the overall operation of the organization, and is assignable in part to the award. Applying allocability in practice requires categorizing each cost based on its relationship to your grant activities. Most costs fall into one of three categories. Fully allocable costs are those incurred solely for one project. If you hire a research assistant who works exclusively on your grant, their entire salary is allocable. If you purchase equipment that will be used only for grant experiments, the full cost is allocable. The key is exclusivity. The cost serves only this grant. Partially allocable costs benefit multiple projects and must be divided proportionally. A staff member working 50% on your grant and 50% on another project has half their salary allocable to your grant. Supplies used across multiple projects should be allocated based on reasonable estimates of usage. The allocation method should reflect actual benefit to each activity. Not allocable costs benefit other activities, but not your grant. Your organization's general fundraising costs are not allocable to project grants. Administrative costs that support other programs but not your project are not allocable. These costs may be legitimate organizational expenses, but they cannot be charged to your grant. Documentation supports allocability determinations. Track how costs relate to specific project activities. For shared costs, document the basis for allocation. Time records, usage logs, and contemporaneous notes all help demonstrate that allocations were reasonable and reflect actual benefit to each activity. Certain types of costs regularly require allocation decisions. Understanding standard approaches for common scenarios helps you handle these situations consistently. Personnel costs are allocated based on documented effort percentages. If someone works on multiple projects, their salary should be charged to each project in proportion to their effort. Effort reporting systems, timesheets, or personnel activity reports document these allocations. The allocation should reflect actual work performed, not budgeted estimates if they differ from reality. Supplies are typically allocated based on project usage. If consumable supplies serve multiple projects, estimate the proportion used by each and allocate costs accordingly. For example, if lab supplies support 2 projects equally, each project should bear half the cost. Keep records of how you determined usage proportions. Equipment allocation depends on usage patterns. Equipment used by multiple projects can be allocated based on usage time, proportion of total capacity, or other reasonable measures. If a specialized instrument serves one project 80% of the time and another 20%, costs might be allocated in that ratio. Document your allocation methodology. Space costs, when charged directly, should be allocated based on square footage occupied by grant activities or percentage of time used for grant purposes. If your project occupies half of a shared laboratory, half the laboratory costs might be allocable to your grant. Ensure allocation methods are reasonable and documented. Understanding how the 3 cost tests relate to each other clarifies the overall framework for grant expenditure decisions. Every cost must pass all 3 tests to be charged legitimately to a grant. A cost must be allowable, meaning the type of expense is permitted. It must be allocable, meaning it benefits this specific project. And it must be reasonable, meaning the amount is appropriate given the circumstances. All 3 conditions must be satisfied simultaneously. You can approach the test sequentially, checking each criterion independently. Ask first, is this type of cost allowed? If yes, ask, does this cost benefit my project? If yes, ask, is the amount reasonable? A no answer at any point means the cost cannot be charged. The order does not matter. What matters is that all 3 tests are passed. Failure at any point means the cost cannot be charged to the grant. Even 2 out of 3 is insufficient. A reasonable and allowable cost that does not benefit your project cannot be charged. An allocable and reasonable cost that is prohibited by regulation cannot be charged. All 3 tests must be satisfied. A common pattern involves costs that are allowable and reasonable, but not allocable to a particular grant. Office supplies might be perfectly allowable and reasonably priced, but if they serve your general operations rather than specific grant activities, they are not allocable to the grant. The cost might legitimately be charged elsewhere, but not to this award. Documenting allowability protects you during audits and demonstrates thoughtful compliance. Good documentation practices make audit defense straightforward. Policy reference documentation shows which rules permit the cost. When making significant expenditures, note the regulatory or policy authority that allows them. For routine costs, this may seem excessive, but for costs that might be questioned, having the reference readily available streamlines any inquiry. Prior approval documentation is essential for costs requiring advance authorization. Maintain copies of approval requests and responses, note dates, approving officials, and any conditions attached to approvals. If an auditor questions the cost, you can immediately demonstrate that proper approval was obtained. Award terms compliance should be documented for any costs subject to specific restrictions. If your award limits travel to a certain amount or requires prior approval for equipment, document compliance with these terms. A simple note confirming you checked the terms before incurring the cost provides important protection. Negative evidence documenting the absence of prohibitions is sometimes useful for costs that seem questionable but are actually permitted. If an unusual cost is allowable despite appearances, documenting your research into the issue shows due diligence. A note explaining that you reviewed applicable rules and found no prohibition demonstrates thoughtfulness even if no explicit permission exists. Allocability documentation demonstrates that costs charged to your grant actually benefit the project. Strong documentation protects against questions about whether charges were appropriate. Project purpose documentation explains how each significant cost serves grant objectives. When you make a purchase, note briefly why it was needed for the project. What activity does it support? How does it advance project goals? These explanations should be brief but clear enough that someone unfamiliar with your project could understand the connection. Allocation basis documentation explains methodology for shared costs. When you allocate costs across multiple projects, document the basis for allocation. What measure did you use? Why is that measure appropriate? How did you calculate each project's share? This documentation should be developed when the allocation method is established, not reconstructed later. Usage records provide evidence of actual utilization supporting allocations. Time records show how personnel divided their effort. Equipment logs show which projects use shared resources. Supply inventories track consumption across activities. These records transform allocation estimates into documented facts. Contemporaneous records capture allocations when made rather than later. Deciding months after the fact how to allocate shared costs invites questions about accuracy and motivation. Document your allocation decisions as you make them when the information is fresh and your reasoning is clear. Common allowability mistakes cause audit problems that could have been prevented with more careful attention. Learning from others' errors helps you avoid similar issues. Assuming permission leads to problems when costs turn out to be prohibited. Do not assume that because a cost seems reasonable or is common in your field, it must be allowable. Check the regulations and your award terms before incurring significant or unusual expenses. The time spent checking is far less than the time spent responding to audit findings. Ignoring award terms specific to your grant causes trouble even when costs are generally allowable. Your notice of award and attached terms may include restrictions beyond standard regulations. Review these documents carefully and keep them accessible. A cost that is normally allowable might be specifically prohibited in your award. Missing prior approval for costs requiring advance authorization can result in disallowance even when the cost would have been approved if requested. The failure is procedural, but the consequence is real. Know which costs require prior approval under your award and obtain authorization before committing funds. Relying on outdated information creates compliance risk because regulations change. Thresholds get adjusted, definitions get modified, and previously allowable costs may become prohibited. Verify current requirements at ecfr.gov rather than relying on old training materials or remembered rules. What was accurate 3 years ago may not be accurate today. Allocability mistakes often stem from convenience or insufficient attention to documentation. Recognizing common errors helps you maintain proper practices. Convenience charging means charging costs to whichever grant has available funds rather than to the project that benefits. This is improper regardless of intent. Each cost should be charged to the project it benefits, not to whichever budget can absorb it. Grant funds are not interchangeable pools. Each award has specific purposes. Inadequate tracking prevents you from demonstrating that costs benefit specific projects. If you cannot explain how an expenditure served your grant's objectives, you cannot defend its allocability. Build tracking systems that capture project purpose for each significant cost. The extra effort during purchasing saves major effort during audits. Unreasonable allocations use methods that do not reflect actual benefit. Allocating costs equally across all grants when one project benefits much more than others is unreasonable. Allocation methods should approximate actual benefit even when precise measurement is impossible. Arbitrary or convenient allocations invite questions. Inconsistent methods raise red flags during audits. If you allocate similar costs differently without good reason, auditors wonder why. Changing allocation approaches mid-project suggests manipulation rather than accurate tracking. Establish reasonable allocation methods early and apply them consistently throughout the project. Building good practices around allowability and allocability makes compliance routine rather than burdensome. These habits protect your organization and make audits straightforward. Check before spending by verifying allowability before incurring significant or unusual costs. Take a moment to confirm the expenses permitted under regulations and your award terms. For routine costs, this becomes automatic. For unusual costs, explicit verification prevents problems. Document purpose by noting the project connection for each significant expenditure. A brief explanation of why the cost was needed for the project takes seconds when the purchase is made, but becomes difficult to reconstruct months later. Build this documentation into your purchasing workflow. Allocate consistently using reasonable, documented allocation methods. Establish your allocation approaches at project start and apply them uniformly throughout. When staff work on multiple projects, use the same method to allocate their time across all of them. Consistency demonstrates systematic practice rather than ad hoc decisions. Review regularly by periodically verifying compliance with cost requirements. Do not wait for audits to discover problems. Monthly or quarterly review of expenditures against allowability and allocability requirements catches issues early when correction is easier. Build compliance checks into your regular grant management routine. Let us summarize the key points from this lesson on allowable and allocable costs. Every cost charged to a federal grant must pass 3 tests: allowability, allocability, and reasonableness. We focused today on the first 2, while the previous lesson covered reasonableness through the prudent person standard. Allowability asks whether a type of cost is permitted by applicable rules. Some costs are universally unallowable under federal regulations, including alcoholic beverages, entertainment, and lobbying. Other costs may be prohibited by specific funders or by your award terms. Always check all applicable sources to confirm allowability before incurring significant costs. Allocability asks whether a specific cost benefits your particular project. Costs that serve your grant's objectives are allocable. Costs that benefit other activities are not. When costs benefit multiple projects, they must be allocated proportionally based on reasonable methods that reflect actual benefit. Documentation is essential for both tests. Record your basis for determining allowability and your methodology for allocability. Contemporaneous documentation captured when decisions are made provides the strongest audit protection. In our next lesson, we focus on direct costs in detail. We will explore what qualifies as a direct cost, how to identify and categorize direct costs, and best practices for budgeting and tracking direct cost expenditures. Understanding the direct cost category prepares you for the subsequent lesson on indirect costs. Practice exercise. Review a recent grant expenditure and document its allowability and allocability. What rules permit the cost? How does it benefit your specific project?